Yeah, so Adrien Treccani, I'm one of the founders and CEO of the company Metaco. Company specialized in digital assets custody in the banking sector.
Levin Böhnke. I'm head of research at Crypto Finance AG, where I have an eye on the peculiarities of this asset class and how to deal with that in an institutional setup. And I'm also CTO of Crypto Storage AG, one of the companies in the Crypto Finance group, where probably we are competitors with Metaco, building infrastructure so that banks can do the custody themselves.
My name is Patrick Winkler. I am co-founder and CEO of SICPA. SICPA is a company to develop a trusted platform in order to protect critical application and sensitive data like crypto asset.
My name is Hubert Ritzdorf. I'm CTO and co-founder of ChainSecurity, and we review smart contracts. And as many stablecoins are built on top of smart contracts, we have actually reviewed a number of those and tried to make them as secure as possible.
Okay, so thank you very much. So let us shoot with our first question that I will ask to Adrien. So we saw that there are a lot of economic issues in the presentation of Kalin. So first question, of course, would be what are the economic motivations of using stablecoins, and especially with respect to one of the obvious competitors, which are the whole bunch of cryptocurrencies?
Yeah, so I would say the first thing is cryptocurrencies have mainly two issues, at least two issues from a usability perspective. One is they are very volatile, and the reason for that is they are not backed by one central party, like a central bank, that is here to decide what should be the value exchanged against other assets in the market. They have generally a deterministic scheme, a deterministic monetary policy that doesn't really care about the demand for the assets. Typically, Bitcoin was designed to be deflationary. It is comparable to gold, so the more it is created, the harder it gets to get new coins in the market. So that's one thing. It's very volatile, and we should not expect that volatility decreases significantly unless maybe liquidity improves. Second thing is about the speed or the efficiency of the network. Because these networks are highly distributed, they are inherently slow and hard to scale to the thousands of transactions that an economy could need. So having a stablecoin is essentially solving, or at least partly solving, these two issues. First, it can allow you to have something stable, as the name indicates, that you can use for day-to-day transactions. It can be a unit of account, a good store of value, well, depending on the inflation. Second, depending on how you implement it, because it is more centralized, is also more scalable, it can be faster, and it can potentially process much more than a dozen transactions like Bitcoin per second.
Okay, so we have, I think, understood there are a lot of advantage of the stable coins with respect to cryptocurrencies, but well, I'm not a specialist, but it seems that there are quite a few technical requirements for the stable coins, and they are not probably as easy as other solutions. So I would like to have the view of Hubert and Patrick on that stuff.
From my point of view, we need to have cryptographic agility. The idea is that to develop B2B infrastructure. And in this case, we don't like it in Europe to do innovation in the security sector. In this case, we need to innovate, to do some new infrastructure for protect the different cybersecurity risks.
A lot of good points were already mentioned. So the innovation is key, especially because if we think about stablecoins, because they can be built on top of different platforms, as Adrien mentioned, and then they can actually have quite different properties. And depending on what their use case is, what they are stable against, and so on, that can be really interesting. So I think, as was said in the presentation, I think this is definitely not the final stage of what we're going to see.
Okay, so as you have just mentioned, so I would say all the crypto companies could try to build on the existing platform, etc. So there might be also new crypto companies who want to use stablecoins. But if you have read the newspaper recently, you know that the FINMA has just issued some proposals of regulation of Libra and stablecoins. So natural question is, can the legal FINMA requirement be implemented by those companies, and how?
Yeah, that's actually a good question, because so maybe to give a little bit of background on this, as not everyone might have read the FINMA guidelines, and not everyone might be aware of exactly how stablecoins typically work. So there's this, let's say the easiest way probably to build a stablecoin right now is on top of Ethereum. Maybe I'm a bit impartial here, but also. Anyway, the problem is that you need some platform, and Ethereum already gives you this platform. So on top of Ethereum, you can build a smart contract, and this smart contract can define the rules of your stablecoin. And this smart contract, for example, defines the rules of transfer. For example, are there any fees if you transfer the stablecoin, or who can create new coins, and so on and so on. So FINMA now gave out interesting regulation which said that all these companies that regulate under Swiss financial regulation, they need to know whom they're getting tokens from and whom they're sending tokens to. And that sounds like we're used to this from the banking world, but that's actually a bit more tricky in the crypto world, because there's someone else who gives out the stablecoin and someone else who controls the stablecoin, and I might hold some of these stablecoin and might now send them to SEBA or Signum, who are these new crypto companies or blockchain service providers, and they're not even allowed to take them because they might not know who I am. So the power of stablecoins has been so far that they are, like, as we heard, they're very, very fast to move around, like you can onboard quickly and so on. But now we see a bit of regulatory pushback from FINMA, because FINMA says, like, if you as a blockchain service provider under Swiss law accept them, please know whom they're coming from.
You're right. FINMA was very strict on this point, but we'll probably talk more about FINMA guidelines later as well. This can, for example, but also be implemented into the stablecoin in form of whitelists, in form of these addresses are allowed to receive the tokens, and then you do not necessarily need to identify your immediate counterparty, but just somebody did the KYC on that. Well, that opens also all the questions surrounded by how do you interact with that token? How does the issuing party interact with that token to add new participants to that whitelist, to remove maybe participants to that whitelist? This becomes very security relevant. So it does open also. I like that part that some of the technological part and the regulatory part are interacting with each other quite a lot.
So if I understand, when security and traceability is really an issue in terms of FINMA, or they fear some problems in data. So Adrien, do you have something to say about that?
Yeah, I think an interesting point is that Bitcoin today is mainly regulated at the in and out. So if you want to buy Bitcoins, you're going to be regulated. You have to tell the exchange or the broker who you are. If you want to sell your Bitcoins, you also have to say who you are. You do your KYC, and the company that provides you this service knows who you are. And essentially then using the Bitcoin within this closed environment of the Bitcoin blockchain or any other cryptocurrency is almost non-regulated, right? If you accept Bitcoins, but you're not a broker, you should be fine. Now, that only works because we assume that at some point, Bitcoin will be converted back to Swiss franc or dollar. Think about Libra. The big question I ask myself is, once you have 2.7 billion users that are using Libra, should you really expect that somebody is going to convert it back to dollar at some point, or is it going to remain actually a closed loop within Libra users, which represent a third of the entire worldwide population? So I'm pretty sure that the FINMA and other regulatory bodies are actually going to push very strongly against having Libra being used like Bitcoin, precisely because in and outs might be much more rare than they are with Bitcoin.
Okay, so thank you very much. So we have talked about the fears of the FINMA and potential solutions. So, of course, you have heard about in the news a lot about Bitcoins who have been stolen or who have been lost. Okay, so one fear that can have the end user is whether it's also possible for stablecoins? And if it's the case or it's not the case, and if it's not the case, how can we secure them? So, Levin, have you something to say about that?
Sure, that's again one of the points that very much is related to the technology that's being used. For Libra, for example, as far as you can read it in the public white papers, it's not envisioned that the client, the retail client, can actually hold his own key. So that risk is probably mitigated quite a lot. He only can use the participants of that network, or has to go via one of these. How many is it right now? 23, I guess, in the beginning. They intend to have up to 100. You have to go through those. You cannot have your own view of the blockchain. This verifiability is severely inexistent, essentially, and you cannot hold your own private key. For other stablecoin projects, that's of course very different. For this Swiss franc, crypto Swiss franc, for example, that's essentially an ERC20 token on the Ethereum blockchain. They have the same considerations. Usually in those contracts, there is also the option that the issuer has certain rights in this smart contract. So can maybe undo a transaction or can burn tokens that have been shown to be stolen, or can create new ones which can be used for all kinds of governance actions. But this again comes with set security concerns that I mentioned previously, that those governance options, I mean, essentially you have something like a digital money printing press. How do you secure that?
So in the end, everything is related to governance. Who is allowed to control your assets? In the case of Bitcoin, you are your own bank. You take your phone, you have the private key, so this long password that controls your funds that is generated in the phone, and then nobody can help you recover them if you lose this key. Well, depending on how the stablecoin is implemented, it could be that, in fact, you have this central body or an associate of the central body that has some special rights to recover your lost funds. Now, it has to be designed in the protocol itself. And I'm pretty sure, I don't know how Libra has been designed. I have not looked at the protocol in details, but I'm pretty sure that they will have some form of super god power to move some assets back or to change some of the rules in very exceptional cases. Let's just think about the cases where Libra coins are used for criminal activity.
Patrick, do you agree with the type of statement of Adrien about whether they can be secured or not easily? Or?
Yeah, absolutely. And from my point of view, what we need to do rapidly is to do an assessment of this risk they are around this kind of digital asset. And what we did some year ago to have a list of the risk and to develop some standard for protect this kind of risk.
Okay, so I have in fact another question for you, and Adrien mentioned also the notion of key, etc. So if I understand well, if you look at stable coins, of course, you will issue also some coins. Now, all of them will not be issued at the same moment, so it's an ongoing process, and there will also a kind of burning existing coins, okay? So I think it's when you speak about securing some stuff, is in fact it's a dynamic system. It's over the whole life cycle of those stable coins. So is it just about key management, or there is no issues?
Yeah, no, it's the key management. But in the past, I was in charge for develop a e-nota for central bank in South America, and we try to develop this kind of infrastructure for generate this e-nota for this country, and it was only key management. But as usual, in the security field, we have some solution developed for the B2G market, for the army, for government, and we adapt this kind of technology for the B2B market. And in this case, we need really develop a solution for the business need, because they are some business need and some security, and we need to find the very good level for generate a business and protect this kind of business.
Yeah, of course.
Okay, so.
Oh, sorry, go ahead.
Thank you. So again, with Bitcoin, it's just about holding the assets and having the right to transfer it. If you think about a stable coin, you have this central body that is issuing more coins and potentially removing coins from the market. And you have all of those rules that you need to define who can do that, under what conditions, and what happens if you have a horrible systemic event like somebody creating $1 trillion worth of stable coins. You need to be able to say, well, is it going to be irreversible? Should I just live with this new inflation in the system? Or should I have some special rights to control the life cycle, potentially reverse some extreme transactions, and make sure that the system is under control? So when you speak about life cycle, I think it's really more than just managing keys. It's managing keys, but it's also using these keys to have a secure workflow, secure operations that control the coin from its creation, the issuance, down to its burning when you remove the coin from circulation.
Yeah, I would agree with that, and I would just add that, like, I mean, in security, we like to think about roles. Like, I mean, as you mentioned, who has which roles? And of course, in the end, it comes down to key management. But like, for example, what we've also seen with some clients that have issued stablecoins, they got regulatory pressure to put in these conditions that they can freeze certain funds, because now there might be, like, the FBI might knock on their door and say, like, please freeze those coins, and then they have to have the ability. So, so they had to put it in from the beginning, but they technically, and this is again what was said before, regulatory and technical are very intertwined. They technically put this into a different role, which can kind of be seen as the police, which is only used in these very rare circumstances. So, of course, in the end, then it comes again down to key management, but by designing the system into different roles and thinking about the life cycle cleverly, you can, of course, also improve the overall security.
I mean, what I would really like to add is, you have to think about who does these things. Right. In banks, you typically have setups that say transfers above a certain amount, say 1 billion, only the CEO can approve those transfers. That's, of course, not what happens. The CEO signs a piece of paper, and then the ops team feeds the information. Yeah, the CEO signed the paper into the actual transfer. If actions are irreversible, especially, for example, money creation or freezing, unfreezing of accounts, if that is irreversible, then it has to be that the person who's responsible, the person who does the decision in the end, or the team, feed that information into the blockchain themselves. That it's not just them signing off and then an ops team does the work, because otherwise the ops team's too security relevant. So in those cases, we really also have to build infrastructure. And of course, we're doing that, but we have to build infrastructure that allows a very naive approach, right? The CEO of a bank might not be tech adept to interact with the Ethereum blockchain, maybe. So we have to make it as simple as possible as well. Simplicity or convenience, usability very much becomes a security concern in those types of environments.
Okay, so thank you very much. So we have talked a lot about securitizing the Bitcoin, the stable coins, etc. Now, a natural question is, when we see the big difference between Bitcoin or the Libra, is the asset-backed type. Okay, so what I have learned, I think it was in 2008, we saw that asset-backed securities like CDO, CLO, or fancy credit derivatives, they are asset-backed. Okay, but we might suffer severe issues, okay? So what I would like to know is, because we know that those assets who backed the Libra or stable coins can be subject to risk in the real world, like political, geopolitical risk, regulatory issues with change, etc., or mismanagement. How can you handle that in the Libra? So what is different or what is similar? So, yeah.
Yeah, I guess there's many things to say, so I will not cover all of them, but maybe to quickly start, I mean, in the presentation, one of the core points was mentioned, and that's auditability or transparency, however you want to call it, and that differs very greatly between the stablecoins, right? So, for example, there is the famous example of Tether, the stablecoin against the US dollar, which originally promised that 1 Tether would correspond to $1. Now they had to publicly admit that they don't have as many US dollars as they have given out Tether. But the price didn't drop because they had at least 70%. So people were like, okay, that's better than a bank that has like 5% or something. But sure, this is a bit weird, but raises exactly the point that you do for most of these. Currently, you don't have the transparency to see if the assets are really there. And if they are asset-backed, then you need to know that the assets are there, because otherwise you don't know what your coin is worth. And then we're kind of back in fiat country. So I think transparency is key, and as it was mentioned in the presentation, transparency seems to be lacking completely for Libra.
I think history repeats itself. If we look at the past, central banks have quickly started to debase their currencies once they could do it. Because in the end, if people use the currency, the fact that there is some backing, like there was with gold, it might no longer be relevant. But the same thing can be said with stablecoins. If you can't attack the coin itself, you can attack the collateral. If you have a collateral, the issuer could decide that he will start debasing and slowly but surely have no collateral at all, potentially having a fiat currency, but a private fiat currency that is used now globally in a complete network with billions of users, and who knows, might no longer require any collateral at all.
If I understand well, stablecoins it's related to the notion of ledgers, and the ledgers can be permission or public. And what we know that there are some complexities related to public ledger. And one of the main problem and the main complexity is the notion of fork. And in the presence of forks, it can make the problem really nasty and very difficult to monitor, to understand, etc. So again, a question would be, do we fear that as well if we use public ledger in a stablecoin context?
Sorry. Yeah, just quickly from my side. I mean, in general, there's like technically, I mean, given that I'm a technical person, that technically there's not that much different stablecoin on private blockchain with stablecoin on public blockchain. But of course, you mentioned the forks, and so basically, if we have an asset-backed stablecoin, let's say it's back to the US dollar, and now 1 million of these coins have been given out, and now there's a fork. Suddenly, there's 2 million of these coins now, right? But there's still just $1 million in the bank. So clearly, at one of these forks, whoever the issuer is has to decide, like, which way of the fork do we go?
Exactly, and when you have a fork with a native cryptocurrency like Bitcoin, it's already an annoying event, and that's one of the biggest challenges for banks that integrate such currencies today in their workflows. But if you have such a thing, there is the market force. One of the forks is going to be worth maybe less, the other fork is going to be worth more depending on the adoption of these two forks. The problem once you have an asset-backed once you have a stable coin which is backed by a collateral is that if you have a fork, the asset exists on both branches. And somebody has to decide which branch actually refers to the collateral and which one should not be considered at all. There is no market force. It's a pure binary decision to be taken by somebody. And again, it's all related to governance. Who is this somebody? Is it the issuer? Is it the regulator? Is it statistics? Maybe one is more used than the others. It's hard to know, and I think this is one of the weaknesses today of stablecoins on the Ethereum chain or public ledgers in general.
Mm-hmm. Yeah, it's a problem of the public ledgers. It's much less a problem of private ledgers. I'm not a particular fan of private blockchains, because then we very quickly come to this, why don't you just use a database type questions? But there are mixed forms. I think this is a false dichotomy to say, is it a public or is it a private blockchain? There are at least 3 axes. So you essentially have a cube of private permissions, public, where who can read, is this private or public? Who can write, so execute transactions, is that private or public? And who can bring the consensus forward, is that private or public? And for the verifiability, which is the one thing that we probably all agree on and has been mentioned a few times, it's just the readability that is necessary. So you could essentially have a mixed form where bringing the consensus forward is a centralized or private operation, but you still have full verifiability in this operation. And to the best of my knowledge, I do not know of any such projects. But in a local market, say Switzerland, where if some financial market infrastructure provider takes on this role of getting the consensus forward, but essentially apart from that, you do have just a stablecoin on a chain. This is something that I would very much like to see for the purpose of stablecoins, for specific purposes, for maybe shares on a blockchain. If you really aim for censorship-resistant money, use Bitcoin, right?
Okay, so before we go to the Q&A session, so I have a last question for our panelists. So if you read the newspaper, and especially the French-speaking Swiss newspaper, so you know that the Libra is Geneva-based, the Libra project is Geneva-based. You probably know as well that David Marcus, who is behind that project, is also Swiss. So a natural question is, which country will be first to give out a stablecoin by its national bank? So will it be the SNB or not? And if it's the SNB, what will be the effects for you?
So I think it will be very interesting to have Kalin then in the panel to answer this question and have his views. One thing is to discriminate between the different forms of coin created by a central bank. A coin created by a central bank, a so-called CBDC, doesn't have to be something that you touch. That would be a retail CBDC. But it could be a coin that is only used for very specific use cases like settlement, for instance, like a settlement coin that only banks, commercial banks, actually use. So I think as a first step, we will see multiple of these initiatives like settlement coins that are used by banks or between banks, but you in the retail actually don't touch at all. Having a CBDC that you can have in your wallet aside of your Bitcoins is of course the most incredible innovation that we will have in the soon future, but when it's going to arrive, I think central banks have shown that they are relatively slow in adopting new technologies, very risk averse, but I would be happy to have, of course, Kalin's opinion on that.
So I think China already announced their intention to be first, but in reality I think that the first central bank to issue digital currency will be the first that cracks all these hard problems that stand behind. What would happen if you make available to the general public something that moves in nanoseconds rather than in days? The distribution of cash to reach your pocket is something that is quite complex. If you just think from the moment it is created as a design through the printing to the moment it is made available in its final form and distributed through the commercial banks, all the way to the ATM where you just go and type a PIN and all of a sudden walk away with a banknote. This takes a while. So what happens if you have that and you just do this on screen? How this will impact the economy, the stability, the financial framework. All these questions are being explored by central banks and regulators. And whoever cracks it first, I'm sure they will try to capitalize and grow the influence of their own respective currency. But until that time, do not expect anything more than flashy headlines.
So are the other panelists agreeing with that, or?
Yeah, I was especially thinking about the effects, as you mentioned. I mean, as you mentioned, the great benefit is the liquidity. Well, liquidity is maybe not the right word, but the speed at which we can move things and the reduced friction that we have in the financial market. And actually, this reduced friction might have very severe effects because in the end, there's a lot of people that are currently making money off this friction because, yes, it's hard for you to wire money to a foreign country, and if you're in that foreign country and you withdraw money from an ATM, you pay a nice fee and so on, and all these frictions, there's currently people making money off this, and a lot of this friction would suddenly disappear or would be significantly reduced, so this might have quite severe economic effects. I just want to point out one minor detail that there is a tiny nation called the Marshall Islands in the South Pacific that has now decided to emit such a coin. However, they were in a slightly easier position to do this because they never had their own currency, so they always used the US dollar so far. So they didn't have to kick out an existing system, and they can kind of start from scratch. And of course, their economic value is also a little bit different than some of the major countries we see. But I've heard that other national banks will have a close look at the small islands to see what's going to happen there.
I'm just surprised that nobody mentioned Venezuela yet, having already a cryptocurrency, state-based cryptocurrency, stablecoin, yeah, it's a commodity-based stablecoin for a while now. Anyway, what I would like to mention, it's probably not the first one, or not, might even put them at the last position, but just yesterday, 2 days ago, the federal government of Germany published a strategy paper on blockchain, which was very progressive in some areas. Apparently they want to see bond on the blockchain very, very soon. They are much faster than anticipated. On the other hand, they have a section about stablecoins where they very explicitly state, we will lobby against stablecoins, right? Against asset-based or currency-based stablecoins, just because it's violating the sovereign of that's the role of the sovereign nations at this point. They do leave open this possibility of having a state-issued currency, which is a CBDC again, but they even say, even internationally, they will try to lobby against existence of asset-based stablecoins.
Yeah.
I think that you mentioning the German blockchain strategy comes on the back of, like 2 days prior, both the governors of the German Bundesbank, but also the French National Bank, came out with a statement and said that no private entity will be allowed to take away things that are reserved for the state. And one of them, of course, referencing Libra, talking about the monetary sovereignty to issue a currency. So I think we're very clear on where the delimitation is on the public-private partnership, and that the public side now clearly states where the line is and that what line should not be crossed. But just coming back to the Marshall Islands, it was a very fancy announcement. Of course, they had sort of a blank sheet. What's interesting is that literally within the same news cycle, the IMF came out and said, be careful what you're doing, for you may lose access to the financial rails. So they were basically swinging SWIFT at them. So they may end up very much in the Venezuela case, where they have their beautiful currency, but it only works on the islands.